Most financial collapses don't begin with chaos, they begin with calm. In 1996, Thailand looked stable. Growth was steady, investors were confident, the currency seemed secure. And then, in 1997, the entire Asian financial system cracked, starting right here in Bangkok. Today, nearly 3 decades later, Thailand once again appears stable. Tourism is back, the baht isn't collapsing, banks look healthy, headlines aren't screaming panic. But here's the uncomfortable truth. Some of these same warning signals that appeared before the Asian financial crisis are quietly flashing again. High household debt, heavy dependence on external demand, a fragile property sector, political uncertainty that never fully disappears. So the real question isn't whether Thailand looks stable. The real question is this: are we watching another calm before the storm? In this video, we'll break down the hidden vulnerabilities inside Thailand's economy, the external risks that could trigger a shock, and the 3 realistic scenarios that determine whether Thailand faces stagnation or something far worse. Because history doesn't repeat exactly, but in financial markets, it often rhymes. And if Thailand is standing at a familiar crossroads, investors and the entire region need to know before the cracks become visible to everyone else. On the surface, Thailand doesn't look like a country on the edge. Tourism, the backbone of its economy, has rebounded strongly since the pandemic. Airports in Bangkok are busy again, hotels are filling up, Chinese and regional visitors are slowly returning. For a country where tourism contributes a significant share of GDP, that recovery alone creates an illusion of momentum. The currency, the Thai baht, isn't in free fall. Inflation is manageable compared to many Western economies. Growth isn't spectacular, but it's positive. Around 2 to 3% expansion may not excite investors, yet it doesn't scream crisis either. From a headline perspective, this is stability. But here's the uncomfortable pattern we see in financial history. Collapses rarely begin when things look terrible. They begin when things look fine. Before the Asian financial crisis, Thailand also appeared stable. Growth was strong, capital flowed in, the property market was booming, there were no dramatic warning sirens, just quiet structural imbalances building underneath. And that's the key word: structural. Surface level indicators, GDP growth, tourist arrivals, currency stability, are like the paint on a building. They tell you how it looks, they don't tell you whether the foundation is cracking. Thailand today faces deeper issues that don't show up immediately in headline growth numbers. High household leverage, demographic aging, export dependence, and political uncertainty. None of these cause instant collapse, but together they create fragility. And fragility is dangerous in a world of rising global interest rates and slowing trade. History shows a strange psychological pattern. The closer a system moves towards stress, the calmer it often appears. Confidence stays high until suddenly it isn't. So the real question isn't whether Thailand is growing. The real question is whether we are confusing short-term recovery with long-term strength. Are we seeing resilience, or are we misreading stability again? If stability is the surface, that is the pressure building underneath. Thailand has one of the highest household debt to GDP ratios in Asia, hovering around 90% of GDP in recent years. That means Thai families, on average, owe nearly as much as the entire economy produces in a year. Mortgages, car loans, credit cards, personal loans, consumption has increasingly been financed by borrowing. And that feels manageable until the cost of that debt rises. For more than a decade, ultra-low global interest rates made borrowing cheap. Money flowed easily, but the world has changed. As major central banks tightened policy to fight inflation, global borrowing costs surged. Even if Thailand's rates remain relatively moderate, it doesn't operate in isolation. Higher global rates mean tighter liquidity, stronger dollar cycles, and more cautious investors. When debt is high, even small rate increases matter. Monthly payments rise, disposable income shrinks, consumption slows, defaults begin quietly, not dramatically but gradually. Then there's the corporate side. Thai companies are deeply exposed to property, tourism, and exports. Property developers expanded aggressively during periods of easy credit. Export-oriented firms depend heavily on external demand, particularly from large trading partners in Asia and the West. If global demand weakens, revenue falls, but debt obligations remain fixed. That mismatch is where fragility hides. Financial crises rarely start with poverty, they start with leverage. When households, corporations, and financial institutions are all stretched at the same time, the system becomes sensitive to shocks. And history shows a repeating pattern. Before major financial disruptions, debt levels tend to look sustainable, right up until confidence shifts. The numbers don't explode overnight, they slowly tighten the system like a spring. Leverage is dangerous because it amplifies everything. In good times, it boosts growth. In bad times, it accelerates collapse. So the question isn't whether Thailand has debt. Every country does. The question is whether that debt becomes the silent trigger when the next external shock hits. If debt is Thailand's internal pressure point, China is its external one. Over the past 2 decades, China has become Thailand's largest trading partner. Factories in Thailand feed into Chinese supply chains. Thai agricultural products, electronics, and intermediate goods move north. Chinese capital flows into infrastructure, manufacturing, and real estate. And perhaps most visibly, millions of Chinese tourists have powered Thailand's service economy. Before the pandemic, Chinese visitors made up the largest share of foreign arrivals. Entire hotel chains, shopping centers, and property developments quietly adjusted their business models around this one source of demand. That's not diversification, that's concentration. The risk isn't China collapsing. The risk is China slowing structurally. China today faces demographic decline, high property sector debt, weaker consumer confidence, and shifting global supply chains. Growth is no longer the explosive 8 to 10% engine it once was. It's slower, more uncertain, more domestically constrained. And when a giant slows, everyone connected to it feels the drag. If Chinese consumers travel less, Thailand's tourism revenue weakens. If Chinese construction slows, demand for Thai raw materials falls. If Chinese manufacturing faces global trade restrictions, Thai exporters inside those supply chains feel the shock. Then comes the second layer, real estate. For years, Chinese buyers were significant players in Thailand's condominium market, particularly in Bangkok and resort areas. If capital outflows from China tighten or Chinese investors pull back, segments of Thailand's property market lose a major source of demand. And property markets are deeply linked to banks, household wealth, and construction employment. This is how external vulnerability becomes domestic stress. Asia has seen this pattern before, countries tying their growth to a single external engine only to discover that when that engine falters, the domestic economy lacks independent momentum. Export-led models work beautifully during global expansion. They become fragile during synchronized slowdowns. Dependence magnifies exposure. Thailand's growth model relies heavily on being plugged into larger economic currents. Tourism flows, global trade, foreign capital. When those currents are strong, Thailand prospers. When they weaken, Thailand doesn't control the tide. The danger of being tied to a slowing giant isn't immediate collapse. It's gradual suffocation. Growth drifts lower, investment becomes cautious, property markets soften, youth unemployment edges higher. None of it looks dramatic on its own, but together, they compress the economy's ability to absorb shocks. And here's the uncomfortable reality. Thailand cannot influence China's trajectory. If China rebounds strongly, Thailand benefits. If China stagnates for a decade, Thailand must either reinvent its growth model or slowly adjust to lower potential growth. That's the strategic dilemma. When your largest partner is entering a more uncertain era, stability at home becomes increasingly dependent on forces you don't control. And in financial history, that's rarely a comfortable place to be. Thailand's economic story cannot be separated from its political one. Over the past 2 decades, Thailand has experienced repeated political turbulence. Street protests, judicial interventions, party dissolutions, and multiple military coups. Most notably, the 2014 coup led by the Thai military reshaped the country's political landscape for years. Civilian governments return, but the shadow of military influence never fully disappears. Yet here's the surprising part. Markets often tolerate instability. Investors care less about how a system is structured and more about whether it delivers predictability. If growth continues, contracts are honored and macroeconomic management remains disciplined. Capital can coexist with political tension, but there's a threshold. Markets tolerate instability until they don't. The moment political uncertainty begins to threaten fiscal policy, central bank independence, or regulatory stability, confidence shifts. And confidence in financial markets is not linear. It erodes slowly, then collapses suddenly. This is where capital flight dynamics come into play. Foreign investors hold Thai bonds and equities. Global funds allocate to emerging markets based on risk-adjusted returns. If political tensions escalate or reform momentum stalls, international capital doesn't protest in the streets. It exits quietly. First, currency pressure builds. The baht weakens as investors convert local assets into dollars. Then bond yields rise as investors demand higher compensation for risk. Equity markets soften, credit conditions tighten. These are the early warning signs professionals watch closely. Sustained currency depreciation beyond regional peers, rising government bond yields without strong growth justification, persistent foreign outflows from equity and bond markets. None of these alone cause a crisis, but together they signal declining trust. And financial crises are rarely just about numbers, they're about psychology. When investors believe others are about to pull out, they rush to exit first. This herd behavior accelerates movements that might otherwise have remained manageable. A manageable currency adjustment becomes a sharp depreciation. A modest yield increase becomes a funding squeeze. Thailand's political history doesn't guarantee collapse, but it does increase sensitivity. In a highly leveraged, externally dependent economy, confidence is the final layer of defense. If that layer cracks, economic vulnerabilities that seemed manageable can suddenly feel overwhelming. And in global markets, confidence can disappear far faster than it was built. So, after all this, the debt, the China exposure, the political fragility, is Thailand actually heading toward collapse? Not necessarily. But risk doesn't mean certainty, it means probability. There are three realistic paths from here. Scenario 1, the soft landing. Thailand manages a gradual adjustment, household debt slowly declines as growth stabilizes, tourism continues recovering, China avoids a hard slowdown, political tensions remain contained. In this scenario, growth stays modest, maybe 2 to 3%, but the system holds. No drama, no headlines, just slow normalization. It's the most optimistic path and it requires discipline and a bit of global luck. Scenario 2, the stagnation trap. This is the more subtle danger. No dramatic collapse, no currency crash. Instead, Thailand drifts. Growth weakens to 1 to 2%, property softens, youth employment pressures rise, investment slows. That doesn't explode, but it doesn't shrink meaningfully either. The economy becomes stuck in a middle-income plateau, vulnerable but not breaking. Living standards stagnate, confidence erodes slowly. This is not a crisis, it's a quiet squeeze. Scenario 3, the sudden shock. This is the scenario markets fear most. A sharp external trigger, perhaps a deeper than expected slowdown in China, a global recession, or sudden capital outflows from emerging markets, hits while domestic debt remains elevated. The baht weakens rapidly, bond yields spike, foreign investors pull back, liquidity tightens. What was manageable stress becomes a funding problem. Crises don't start with weakness. They start with vulnerability meeting a trigger. So what should investors watch right now? Sustained currency depreciation relative to regional peers, rising household default rates, property market stress indicators, foreign capital flow trends, policy missteps or political escalations. Thailand may not collapse tomorrow. In fact, it probably won't. But history teaches something uncomfortable. Financial crises rarely feel obvious before they happen. The warning signs appear scattered, manageable, even ignorable until suddenly they connect. And ignoring vulnerability has never prevented a crisis. It has only delayed the realization.